Welcome back to Small Caps, ladies and gentlemen. My name is Kerry Stevenson, and today, sit back, get your pen and paper ready, because I'm talking with Clive Thompson. He's a retired wealth manager. He's sitting over there in Switzerland, nice and cold. I'm sitting down here in the Gold Coast, a bit warmer, and I'm really delighted. Clive has had many, many years in the investing universe, and so today I just wanted to ask him a few questions about what he sees going on in the world of finance and potentially what he sees going forward. Clive, welcome to Small Caps. Great to see you. Thank you so much for your time.
It's lovely to meet you, Kerry.
Well, this is the first time we've had
it's the Lunar New Year, so I'll say Gong Shi Fa Cai.
Oh, that was impressive. Say that again, Gong Shi.
Gong Shi Fa Cai. I'm sure my pronunciation is awful, but that means Happy New Year in Chinese, or maybe it's Cantonese.
Well, brilliant. Okay, I can't say it. So yes, it is the Lunar New Year, the year of the rabbit. So let's go down a few rabbit holes then. Clive, first up, let's a little bit about your background.
I first became exposed to investing way before the age of 18, probably not much beyond the age of I guess if I think about it, when I was about 7 years old or 6 years old, my father put in front of me a bar of chocolate and a £1 note and asked me which one I'd take. It wasn't my father, it was my grandfather. And I took the bar of chocolate. It was worth sixpence, old pence in those days. And everybody in the room laughed because I should have taken the pound note, because you could buy 40 bars of chocolates with £1. Of course, you can't buy a bar of chocolate with £1 these days. And much, much later, maybe 2 years later, he put in front of me the pound note, the bar of chocolate, and a gold sovereign, and asked me which one I'd take. But being a wise kid and having wised up that the pound was worth more than the chocolate, I took the pound note instead of the chocolate and not the sovereign. Now, my granddad laughed at that, but his friends didn't quite get it because I don't think they knew what a gold sovereign was. They didn't understand gold back then. But, you know, I did winds up, and many, many years later, he gave me the gold sovereign. I still got it today. I know at one point I took it into shops, Pixley in London, to see what it was worth. That would be about 1975. And they said, we'll give you £10 for it, and if you want to buy another one, it's £25, which obviously wasn't a good deal from my point of view. And I think today it's probably worth several £100, maybe £400, £300, but I've still got it. A few years later, my grandfather was in hospital. I went to the hospital with my mother, and he had a little exercise book, a bit like one of these, and in it, he was writing down the names of some shares he held, half a dozen shares, add the price and the number of shares and multiply one by the other to get the value. Then he added up the column to get the total value. And he had a page every day. He'd look up the price of the Daily Mail, write it down. And I was absolutely fascinated by the fact that the value of each share would change every day and the total would change each day. It was kind of a forerunner to the spreadsheet on paper. And that got me, probably at the age of 13, 14, incredibly interested in the idea of stocks. And as a child, I was also playing Monopoly with my parents. And you quickly learn, if you play Monopoly, that the more money there is in the system, the higher the property prices. That was a game which sort of teaches you that if you print money ad infinitum, as happens in the game of Monopoly, when you pass go, there's more and more of it, the price of the property just goes up and up. And there was also a game called Bulls and Bears, which I don't think many people know, but it was about the stock market, and I played that as well. So I was quite fascinated before I was 18 in the idea of stocks. And when my grandfather died, I helped my mother do the valuation. We wrote off to a stockbroker to get the prices of the date of death of the various shares. And at some point, I read this most amazing advertisement in the Daily Mail. Daily Mail was a full broadsheet back then. And I think it was from something like the Britannia Income and Growth Trust. It was 2 full pages of advertisement, and it was the most amazing investment piece I've ever read in my life. At least it was at the age of about 13 or 14, because it described in words of one syllable how they went about picking the greatest stocks in the world, companies with growth prospects, companies with income, and how this was going to be a wonderful investment strategy forever and ever. And it absolutely gobsmacked me. And I said to my mother, hey, all these shares you inherited, why don't you send them off to, because they were giving a free offer to turn your shares into units, send them off and get the units of this amazing thing. And she did that, and a single piece of paper came back with the Britannia Income and Growth Trust. And many, many years later, when stock markets had gone up, I said, look how much it's worth, you should cash it in, which she did. Unfortunately, that was bad advice because stock markets continued to go upwards for decades and decades after that. But by the age of 18, I was determined to invest in stocks. And back in those days in England, getting invested in stocks was very much a gentleman's club, as I had read, and it was by invitation only.
Oh,
so
I
you
didn't
couldn't
know
get a
that.
stockbroker.
Oh,
Yeah, it was by invitation only, so it seemed. So I wrote off to the stock exchange, which was the way you're supposed to do it, and they would introduce you to a broker who was new and therefore didn't have so many clients. So I got a stockbroker, and I rang him up and said, what shall I buy? And he said, boy, you called me on the right day. Have I got a stock for you? And those were the days when there were new oil discoveries everywhere. Oil had rocketed up, and it was like the Bitcoin or the dot-coms of 1999, or the Bitcoin of 3 or 4 years ago. It was the star investment to get an oil company. So he had found me a company called Eglinton Oil, which had found, according to him, the largest oil field in Venezuela. So I put my entire net worth of £500 into one stock, a small cap with no earnings. But we didn't know that at the time. So, and then I spent the next 3 years watching it wither away to nothing. But that was a lesson for me. Anyway, my career started at the age of 18. I'm now 66, and it was basically advising people on their wealth in every respect, both in trusts, residence, tax, how to deal with their next door neighbors, what to do about their dog. But of course, the bit you get paid for is giving sound investment advice, and they buy something that your firm is selling. So that was my career. But I would say there's a lot of psychology in it too, because people can't always talk to their spouse or their neighbors. So the banker, if you're paying them a fee, you can ring the banker and say, hey, Clive, I've got a problem with my builder, shall I sue him or what? And then you have a discussion about it. So there's a lot of psychology involved. So that's kind of the background, and that being paid to do the job, it's about 47, 48 years of work. And now I'm retired. I don't collect any money from anybody. I don't have any services to offer. I don't want to offer any services. But I'm enjoying my retirement, but I'm still for free answering a lot of questions from friends and other people who contact me about their personal situations related to wealth, finance, residency, taxes, and things like that.
So nowadays you've retired, but you still want to help people because you've got, excuse the pun here, a wealth of knowledge, and I guess sharing what it is that you're doing. And we are living in unprecedented times. I don't necessarily like that word, but it is a time of great change and a time of enormous debt. And so when people are calling you and saying, what should I do? I guess, what are you suggesting to them at the moment?
Well, every message I get or email I get on this is very different. As an example, there was one which I answered this morning. A gentleman's retired. He's had his payout from his company. They get to move into a new house, and they're worried about the cash they've got. What do they do? So each situation is different. So in this particular gentleman's case, the advice I'm giving is you want to buy a new house with the cash you've got. Well, everybody's waiting for lower prices. I think it's a widely held expectation that house prices will go down. So I understand why you're holding off a bit, but then you're worried about the cash you're holding. So I think the advice in that case would be think about making a lowball offer now, and you might be able to buy your house at next year's prices before the crowd arrives, because give it 12 or 24 months and the crowd of people who are holding off will eventually not be able to hold off any longer, and they'll be there in competition with you. But now you can make an offer at next year's price and see what happens. Right. But of course, another bit of advice is to educate yourself. I think in this day and age, you don't have to know just your profession. You have to know two professions: the one you work for and you have to become skilled, or at least have some knowledge about investing. Because if you don't, you're going to have your savings in cash in the bank, and by the time you get to retirement, it won't buy you a fraction of what it was buying you when you were working. So I do encourage people to even just buy a simple book like Beginner's Guide to Investment, find out what's out there, think of the options, and it could be you could be going into collectibles if you have a knowledge about art or dolls or coins or something like that, something very simple. Or if you want to go further, you can go into gold, silver, you can go into equities, you can go into property. There's a whole host of things for people that they might interest themselves in. But what they have to get away from is saving money in the bank when the interest rate is almost nothing, and the inflation rate, that is the monetary printing inflation rate, is much, much higher than the inflation rate or the interest that they're earning.
Clive, do you think that most people are not seeing that? Because like you, real assets investing is very important, and our cash is being whittled away by inflation. It sounds to me like you're saying inflation is here to stay, potentially could get worse, and cash is not the place to have your fiat currency. I don't like to call it money.
I think there's a lot more awareness of it than there was some years ago, because if we go back before 2008, there was inflation, but you could earn interest on your savings, which was broadly in line with the inflation rate. Where we've got to in the last decade is a situation of, up until now, very, very low inflation, at least at the retail price level, the consumer price level. Having said that, the monetary inflation has been immense in comparison. So the amount of money you've got as a share of the total money out there is going down much, much faster than the official price levels are rising. And that's because the money is being expanded by 13 or 14% a year, even if prices were rising by 1 or 2% a year. So one of the reasons for that is technology. If you buy a pizza, it was probably made by a robot. And so there's not too much cost going into the manufacture of goods and services. I mean, it's not like the price of iPhones is going to go up if everybody wants to buy one. They can make an infinite number of iPhones. So a lot of the things we buy at the retail level are not going to rise in price as much as the things which are in short supply, like property, gold, silver, equities, even Bitcoin if you want. But I'm not saying Bitcoin's going to rise, but we can antiques, works of art, paintings. So all these rarer items are the areas where the surplus cash is flowing. But of course, at the end of the day, if property prices are rising, it has an impact on the man in the street who wants more money, and that does work its way through to the retail prices to some extent. But the retail prices aren't really rising as fast as the inflation of the money supply. And of course, you're earning a lot less interest in the bank than even the retail price index is going up.
So what you're saying is, one of the comments you made was you talked gold, you said silver, you said property, art, etc. You also said equities, which I find interesting, because I'm feeling now that there's a little bit of uncertainty in the equities markets, and that there could potentially be another financial crisis like 2008 and a wobble. So is that a place that people should be looking right now?
Well, I've been investing for 47 years, and I think every single year when I've been investing, there's been a lot of bad news on the horizon, things we know which might go wrong. So bad news on the horizon is not new. Of course, there are degrees of bad news. Sometimes it sounds like it could be very, very bad news, and sometimes it's moderately bad news, but there's lots of different stories out there. Equities, obviously, we do know they have bad years and good years. And last year was a very bad year indeed. I think it was down 20% roughly. And 2 bad years in a row are not very common. But of course, it can and does happen. But irrespective of what equities have done or what the prospects are, you'll always find the analysts are forecasting a rise for the following year. After all, their business is selling investments. So they will tend to forecast a rise irrespective of what they personally think. I hate to say that, but I think they're a little bit bullish by the nature of their job. And if I look last year, they were forecasting roughly, if I take the median forecast, about 7% rise, and we end up with -20. So they were wrong by 27%.
Yeah.
This year, they're forecasting I think the median is around 10% rise. It wouldn't surprise me if they're wrong by 20 or 30%. So that would mean we're going to get a rise of maybe 30% or a fall of maybe 20.
You're hedging your bets there, Clive.
Well, yeah, I mean, let me put it this way. I do not know the future, and I never have claimed to know the future. If I knew the future, I don't think I'd be sitting here. I'd be sitting in a gold palace. But you know, if you ask me, I'm hearing the bad news and I see the bad stories about equities, and I'm saying, yep, that's certainly true. And there's some areas of equities one has to avoid. But I'm more inclined, as a guess, and I have to stress this as a guess, I don't know, to say that I'd go with the upside, and that means beating the 10% median forecast. And I suppose the principal reason for that is the nervousness people have got with cash and money, and the quantity which is being printed, and the increased quantity which will have to be printed in the years which come, including this year, 2023. So as more money comes into the marketplace, someone out there is the bag holder. And if the bag holders get nervous, and they're getting nervous, they're going to look for other things to do with their cash, and whether that will flow into one type of asset or property or equities or Bitcoin or gold or silver or equities, we don't know. But my guess is that equities has always been a very popular investment arena, and I think they will go for that even if they expect a recession and if they expect lower earnings in the current year as things slow down and interest rates go up. Of course, it's quite contradictory to say equities could go up when interest rates go up too, because usually they behave in opposite directions. Interest rates normally go up and equities go down, and vice versa. But that's not exactly the rule. It's just more common than not. But so I'm kind of saying we could be in a world where interest rates go up and equities go up in the current, I'm going to say, possibly the next 12 months, most likely over several years.
We will get into, I guess, some of your thoughts of what perhaps Clive is doing, but you mentioned the increase of the money supply, which has been going on for quite some time. We're coming into talk about central bank digital currencies and a global reset. I'd really love to hear your views on, are they going to just keep kicking the can down the road and increasing the money supply? And don't worry about it, Kerry. Just keep printing to get us out of the trouble that we're in, because they've been doing it for a long time. Why stop now? What's your views on where you think this might be headed?
Ideally, they would like to keep kicking the can down the road. So it's the problem of the next generation of politicians. Things are going to come to a head at some point. The level of government debt in the Western economies has reached levels which is clearly unsustainable, and even more so if interest rates rise. And I'm going to take the United States as the biggest economy and the one where I've done the most work in looking into it. We have twin problems in the USA at the moment. One is with the government, where they've once again hit the debt ceiling. I think it's the 90th time, something like that, they hit the debt ceiling, which means they can't borrow anymore. They can keep spending until they run out of money, and that will take a few months to run out of money. Meanwhile, Janet Yellen has written to the Congress to say what they're going to do about it. They're basically going to raid the government, one of the government pension fund plans, to keep paying the bills. I can read you her words if you like.
Yes.
I'll just bring that up. Have I got it here? Sorry, I wrote it down on a bit of paper here.
I'm glad you can find your bit of paper. I can never find the bit of paper.
Yeah. This is from Janet Yellen to Congress about 3 days ago. Payments to the Civil Service Retirement and Disability Fund this is how they're going to pay the bills, are suspended. And we will redeem a portion of the investments held by the Civil Service Retirement disability and disability fund to pay the bills. So basically, they raid the pension fund.
So,
And then she goes on to say, once the debt ceiling is raised, we'll make it whole again.
what a dangerous game.
Basically, the US government has run out of money. It can't pay the bills, and it will have to raise the debt ceiling.
Yeah.
Obviously, there's two ways of doing that. One is to suspend it completely. That would be very bad because basically it turns into a free for all. Whereas at least every year or two, we have a debate going on as to whether the debt ceiling can be raised. And that, of course, brings in potentially some discipline about the spending. There's a few concessions made about cutting spending here or there. But from an investing point of view, if you're talking equities, given the situation we're in, you'd have to be a little bit cautious of those companies which are beneficiaries of government spending. I'm thinking infrastructure, I'm thinking military, defense manufacturers, those sort of things, because some of these areas where the government spends its money will impact the companies which are recipients of that money if they are forced to cut. And I expect there will be some cuts somewhere. But of course, once the debt ceiling is raised again, we'll be back up after the races again. And that will come eventually, I suppose. I mean, it would be awful if it doesn't, because that would mean default by the government.
They're not going to let that happen, though, are they?
Well, I don't think so. But you know, the Kevin McCarthy, the House Speaker, is in a precarious position. So who knows which way it will go? So let's just say I don't think so. But let's look at how the markets are seeing it, because I think that's an important factor. Mm-hmm. The cost of credit default swaps for the United States, 1-year CDSs, has gone off the radar screen. I'm just going to. Can I? Is it all right if I bring up a slide just to show you that?
Yes, please do.
Let me
do a little share screen.
Put that on the screen. I guess I could do that.
Perfect.
Do you see this? Is it back to front? So that's the cost of CDSs against the US default.
Crumbs. That's a hockey stick and a half.
So, yeah, people are suddenly very worried that the USA may not pay its bills, or there may be a problem. Now, to put that in percentage terms of risk terms, that comes down to a little bit more than 0.5% risk, or a bit less than 1 in 200 chance. So the chance of USA defaulting is very, very low.
Right.
But it's a lot higher than it was, and it's about 6 times as high as the risk priced in of the UK defaulting, for example. It's higher than the risk of Australia defaulting. So people are starting to get worried at the moment, and that number might come down in the next day or two, depending on how, well, I say next month or two, depending on how the negotiations go. It'll certainly take many, many months before they raise the debt ceiling, and they have many options before they do that. They can, for example, as we see, they stop paying money into the government pension plans. They can ask some government employees to go home without pay. They can ask someone to work without pay. They can close the national parks. They can do all sorts of things to keep the game going a bit longer. But sooner or later, if the debt ceiling is not raised, they run into a crunch. So there is a potential problem there, and that a crunch means they wouldn't be able to pay the principal or interest on time.
Yeah,
that's the last thing they would default on, but it's a last choice. But I did say there's 2 problems, and the other one is the Federal Reserve. The Federal Reserve is the central bank of the United States, and their assets are much less than their liabilities as we speak. I probably, for the sake of brevity, I won't go into too much detail on that, but it's a fact. The bond holdings they've got, of which there's at least 5 or 6 trillion, are these are bonds issued by the US government, are massively underwater. They're way below the 100% they're valuing them at. They've got a lot of bonds they bought at a premium that's over 100%, and they're carrying that as an asset. That premium doesn't exist because those bonds will never redeem at the higher than 100%. And they're trading below 100% at the moment. So that premium is there as an asset which doesn't exist. And they're currently losing about 2 billion US dollars per week because they're paying out around 4 point something percent to their depositors, i.e. the money market funds and the banks like Bank of America, Goldman Sachs, JP Morgan, who've deposited with them, and they're only earning 2.1% on their bond portfolio. So that's where the 2 billion a week losses are coming from. So what does that mean? Even on that last metric, half their capital and reserves are already wiped out. I think we've got about another 8 weeks to go before it's all gone. So what's needed is a recapitalization of the central bank. So who's going to do that? It's either the Treasury or the banks. So I don't know if the banks will ante up and put money into the Federal Reserve, that's capital in the Federal Reserve. But so let's say it's going to be the Treasury, which is the most likely candidate. Well, don't forget the Treasury has run out of money. It can't borrow anymore until the debt ceiling's raised, and the debt ceiling won't be raised before the Federal Reserve's reserves are capital reserves are wiped out by these weekly losses. So obviously the game will keep going because they're hiding that those losses are being hidden as in fact it's the weirdest accounting you've ever seen on the planet, and they do justify it, but they're booking the losses as if they were an asset. And the argument they put forward for booking losses as an asset is that when they eventually make a profit, they won't have to pay the profit to the Treasury. So that's an asset, a bit like carrying a tax credit on your balance sheet. But obviously it's nonsense accounting from my point of view, and no company could get away with that.
No, but governments can.
Well, that's what they're doing. So we don't know where this is going to go. We've never been here before. It's a new situation, and I think there's some nervousness, and that kind of reflects where the credit default swaps are going on the risk of the US government defaulting. It's not a big risk, but people are seeing it's higher than it was, much higher than it was.
It is somewhere that we've never been before, and so that brings me nicely into what a lot of people are talking about, which is the global reset and the central bank digital currencies. Is this how they can just turn around and say, we're just going to completely reset the system, let's start all over again, and we'll make up some new rules and get ourselves out of trouble that way? Just rewrite the name of the game.
Around the world in history, we have had countless monetary resets. It's actually the norm. Most currencies don't survive that long. US dollar has survived for many, many decades, far more than is the historical average, and so the British pound and also some other currencies around the world. So from a certain perspective, it's overdue for a reset. Now, when countries reset their currencies, it can happen in countless different ways, but there are some generalities. The first generality is the bag holders, those who hold the old currency, tend to be the losers. The old currency, if it's convertible to the new one, you generally cannot convert it all. Let's take the new currency, the Deutschmark, which was introduced in Germany in 1948, introduced into the 3 of the 4 zones occupied by the Western Allies, occupied by France, UK, and America. Up until then, because the currency had become, to all intents and purposes, worthless, people were bartering with cigarettes. But there was still the mark. The old mark was still there. When they brought in the new currency, the first 100 marks you could change at maybe 1 to 1. I don't remember the rate. I don't know the ratio. The next 100 marks you maybe got 60 to 1, and the next 100 marks you got 6 to 1, and the rest you couldn't change.
Wow.
So, but that's not new. The same thing has happened in different ways in countless countries. But I suppose if we go to another similarity, when we have a currency reset, and it's not always going to be the same, as a general rule, fiat-like assets, like bonds, like deposits in cash or cash, get left behind in the old currency. So if you owe money, you generally are on the right side of it. And if you have money or bonds, you're generally on the wrong side of it. As a general rule, salaries get converted to are now paid in the new currency. Shop prices are in the new currency. Taxes are in the new currency. And funny enough, rents tend to get converted over to the new currency. Bearing in mind, politicians are often landowners. So looking after themselves.
Got it.
Now, the situation gets more complicated with contracts. What if you have a contract to buy a machine? You've already signed the contract, and you've agreed to pay for the machine in a year's time. You don't know exactly how that's going to work out, but probably those types of contracts by law will say whatever amount was agreed is now going to have to be converted as if it will be paid in the new currency, but there's no certainty about that. And if one major country resets, all the other countries are going to have to do the same thing at the same time, because there'll be a situation of everybody in every country saying, oh my God, my country will be next, I better do something. And then there'll be a panic set in as people start to try and move their money out of the old currency into tangible assets. So if that happens, there'll be this rush on a global scale, with people trying to deploy their assets, and that in itself will trigger each country trying to say we'll restart the currency with a new one.
But do you think that this is global? Because as I look today, and as I'm speaking to you today, clearly we have the Russia-Ukraine situation. We have China and Russia saying, well, we're actually going to have a gold-backed yuan, and we're going to trade we're no longer going to do petrodollars. Or what I'm saying is, I don't necessarily see everybody going into the same basket, but that there could be a split between East and West, for example.
Exactly. I mean, there's a lot of, there's some new talk about a new currency, which is being nicknamed the R5. That stands for the five currencies which might make up the R5 in a certain sense: the Rial in Saudi Arabia, the Russian ruble, the South African rand, the Chinese renminbi, and the Brazilian real. Yeah. That's where the R5 Rs come for, R5. I don't know if it'll get any traction. And of course, there's other discussions going about a commodity from backed currency from the BRIC nations as well, which might be partially backed by oil or gold. We'll have to see where that goes. I certainly think it'll take a number of years before that gets traction, unless their hands are forced. Now, one of the things we've seen going on in the last decade, and much more in the recent years, is many of these countries have been increasing their gold reserves. Absolutely. Buying gold hand over fist. Mm-hmm. And the reason they're doing that is, if we get to a reset, and they know it's coming at some point, those who have some gold will get a seat at the table for whatever follows. And he who has the most gold will probably call the shots. So there's a race on by central banks to get as much gold as quietly as they can and as quickly as they can. They don't want the price to go up. That would be a bad move, because it will stop them acquiring. It will slow them down in their acquisition process. So they would like the gold price to stay where it is, but quietly and slowly mop it up as they can. And so they're laying their hands on what they can get, where they can get it. But every time there's a spike in the price of gold, they back away to not keep that gold price running. But that's what's going on in the world, because people, central banks, want to have some gold. Now, there's quite a few central banks which don't seem to be doing anything about it. I don't think Canada's doing anything about it. England's not. The UK is not doing anything about it, and I don't think Australia's doing anything about it. Of course, you in Australia have got the gold in the ground, so maybe you can dig it up one day.
Well, no, what we do is we sell it off to other people. We don't necessarily keep it ourselves, rather like the Chancellor of the Exchequer in the UK, who sold all the gold at a very cheap price all those years ago, I seem to remember. I'm not sure how much you've got over there in the UK, even though you're in Switzerland. But so are you saying that central banks are quietly acquiring as much gold as they can, but they don't want to let on because that way the price might run. Do you think there'll be any moment in time whereby people get a bit smart and that gold price will potentially have a run and they can't stop it?
It's possible. You know, I think that they continue to accumulate the gold, and as long as the price remains depressed, people will be coming out of gold to go into things which seem to offer a higher return.
Mm-hmm.
But at some point, they'll change their minds, and then that gold won't be available, and it'll turn into a bit of a rush as to who can get the gold first, and that could easily cause a spike. I did a little bit of maths myself, and this is back of the envelope. It's about how much the gold price would need to be if the Federal Reserve was to have enough reserves to cope with the size of their balance sheet. It's a very rough and ready calculation. Some people will say it should be much higher, but I came up with $8,500 US dollars as a gold price if their gold actually belonged to them. And there's an argument about whether whether the Treasury's got the gold, and two, if the Treasury owns it or whether the Federal Reserve owns it. But certainly, if it was the Federal Reserve's gold, it would have to be a lot higher than today to justify the size of the Federal Reserve's balance sheet and the money supply which is out there.
But Clive, they're just going back to what they're doing now. The size of the debt keeps growing. It's not shrinking. It's getting worse. So why there's nothing else they can do apart from a complete reset, is there? I mean, raise the debt ceiling, kick the can down the road.
I mean, they'd love to keep kicking the can down the road. They'd love to see the debt inflated away without gradually, that means without any panic. But of course, there's a risk that rate of inflation turns into a panic. Now, we see these panics historically when currency resets have been coming, because there's always those who are in the know, who know it's coming. They know something's afoot. So, it's not like you'll get a lot of time, but if one day you go down to the supermarket, there's a queue outside the supermarket and the shop's shelves are empty, you need to be worrying a lot, because it's probably game over. But it could come in a completely different way. It doesn't have to be supermarkets. That was just an example. It could be the bond market. If there's a sudden loss of confidence in the government's ability to service its debt because the interest rates are going up and up, and the higher the interest rates go, the more difficult it becomes to service the debt, we might see the bond market spiraling down. That, of course, is very bad news for everybody in the country who's got a pension fund, and it's a political crisis, it's a crisis, and that might be a good excuse to reset the currency. And you basically say, we shut the banks for a week or 2 weeks, we shut the stock exchange, and in this period, we'll work out the new system. Everybody who's got 5,000 in the bank will get their money changed over. If you've got 10,000, you'll get another 1,000 changed over. And if you've got 100,000, you'll get another 1,000, and the rest, don't worry, you'll be able to change it later, but you'll have to wait. And perhaps to change it, you'll need to do we'll write some rules for you, but it might be money laundering rules, or it might be, let's see if you paid all your taxes on it. Let's just double check you're not a Colombian drug dealer. Who knows what the rules might be. And of course, there's no guarantee you'll ever get to the date when you can change your old money into the new money. You might find most of your old money is left behind in the old currency, and that historically has been the way it's always been.
Okay, so let's get into something which is a little bit more palatable, I guess, which is, I would like to know, what does Clive do in these times? What sort of tools are you looking to get yourself through these unprecedented and challenging times? And what do our beautiful audience out there, they're very sophisticated, they're smart, they're savvy, they love listening to these things, but they're saying, all right, Clive, I understand all this could happen. And, maybe it's going to happen in 6 weeks, but maybe it won't happen for another 60 years. None of us have got a crystal ball. What tools are you using to get smart in this environment?
Great. So the first thing I would say to everybody is don't have all your eggs in one basket. Be as diversified as you can according to your personal circumstances. So property isn't for everybody, equities aren't for everybody, gold is not for everybody, but certainly there'll be some things that you can buy. And it doesn't matter if you're collecting firewood, for example, if that happens to be your thing, or animals, but at least try and deploy your money into other things. So having just one asset. If you have just cash in the bank or just bonds, that's all your eggs in one basket.
Absolutely.
Do not do that.
No.
So I'm certainly not saying get rid of all your cash, even though that might turn out to be a very good thing, because you never know when you have an emergency, you never know when you might need cash and you need something to live on. If you're a pensioner and you don't have a lot of salary, you probably need more cash than if, for example, you have a salary coming in on a day-by-day basis. So each individual circumstances would be different. But if you have surplus cash, my advice is get some of it into other things. And the range of things you can put into your money into which are tangible are vast. And if you don't trust the price of markets going up or down, think about doing yourself a house extension or a loft conversion, or buy a small flat somewhere which you can rent out. I mean, a lot of people are comfortable with property because it's not in your face, where the price doesn't go up and down in your face every day, whereas stock markets and gold and other assets do change their price, and that's very scary for people who are not used to that. And likewise, if you go into collectibles, whether it be collecting coins or dolls' houses or antiques or paintings, again, it's not in your face when the price changes, and you can hold on to these things for a long term as an accumulation of wealth. But can I talk a little bit about how to approach the equity markets? Because I think that everyone should have some equities in their portfolio if they can withstand the risk, and the tools. There's a lot of free tools out there, and I'll just give you a couple of names of the tools I'm using. I'm not connected with any of these companies, and I'm actually paying them for their services. Some of them are in fact free, or they have free versions. One which I think is great for complete beginners is a tool called Simply Wall Street. Street is spelled ST, so it's Simply Wall ST.
Yep.
The beauty of that is it gives you a sort of snowflake picture of each company, which is green or orange or red. Green is good, orange is less good, red is less good. And that snowflake stretches out into the 5 or 6 corners according to how good value it is, how much dividend it's paying, how reliable it is, what the past track record is, what the future holds. So even if you don't understand anything about companies, it's a great way to get a feel if you're onto a solid company, a safe company, or a company which is hopeless. So I find that a great tool for beginners. It's very visual, of course. Yeah. So, and there's a lot of information behind that if you understand the numbers. For those who are a little bit more sophisticated, I pay for a tool called Market Screener. Market Screener is fantastic in terms of the amount of data it's got, but there's a couple of things I like to look at, which maybe people don't look at enough. One is the direction of travel of the analysts' forecasts. So they do a lovely graph for every company. Perhaps can I bring one up just as an example here? I don't know if let me just see if I can get one. I'm just looking here on my other screen. Yeah. I'll bring up an Australian company here.
Oh, good.
Let me try and see if this works.
So
I brought up one called, you may know that company.
Yes.
Let me just move that across to the screen so I can see it better. Can you still see it? It's still not
I can.
And what I look at is I go to the section called revisions, where my cursor is now.
Yes.
And this tells us, if you look at this particular one, it's quite unusual, but it tells us that analysts are increasing their forecasts. In other words, this is the earnings. What you're seeing here are the earnings per share forecast, the average. And so the bottom line is the forecast for 2025, 2024, and 2020. So actually, funny enough, they're going to earn more this year than they will next year and the year after. So actually, it's going down, but the expectation for the current year is rising. But when you look at this, it tells you what the direction of travel is according to analysts. So what you tend to get is one analyst coming up with an increase, and then the next one follows suit, and the one after that. And obviously, it's much better to see regular increases rather than regular decreases in the forecast, because if they're decreasing the forecasts, people tend to look at it and say, I'll sell those shares. And people tend to buy shares where they think the earnings are going to be higher than they were a month ago. So I think that's a great tool. It doesn't actually tell you the future, but it's a useful way. Another one which I like to look at, and I think it's Australian made, is ShareSite. That's great if you're a dividend investor.
Right.
It's not really so much for finding good dividend payers. You can use it for that, but where it comes in particularly useful is to monitor not only the dividends you should be receiving from the investments you hold, but also the dividends that you will receive in the next month or 2 months or 3 months. It also allows you to track a portfolio, or as many portfolios as you want, against a benchmark that you choose. So as an example, I have 2 portfolios. One is the portfolio of the shares I actually own, which I'm tracking against the benchmark. And my objective is to see my personal performance better than benchmark. If I'm doing that right, it's a good performance. And the second portfolio is a portfolio of everything I ever sold. So whenever I sell something, I remove it from portfolio A and put it in portfolio B.
Oh.
Now, if I'm doing it right, portfolio A should be outperforming portfolio B. Portfolio A should be outperforming the benchmark, and portfolio B, hopefully, if it's doing right, will be underperforming the benchmark. So you can tell how smart you are by making investment changes. So that's what I use ShareSite for. It's a really great tool to monitor the performance of what you're doing versus what you didn't do, and also great tool for seeing your dividend flow, seeing what it was, seeing what it will. For example, I a couple of days ago put in all the stocks I currently own and looked at the dividends going back to, asked it to produce a tax report. As it happened, that's the way to do it, going back to 2010 to today, which will then show me year by year the income that those stocks I currently own, the dividends that they would have paid. And if I see the dividend flow year by year rising, that's a good thing. If I see it going down, I probably bought a lot of dud companies.
Right. Well, one of the things that was going through my head is it could be a good thing, but it also could be a bad thing if portfolio B is going the wrong way. Do you know what I mean? So I'm selling stuff and it's going the wrong way. So you've got to start looking at it.
Exactly. Well, that would be sending me a message that I'm wasting my time trying to pick better stocks than the market. I might as well just buy an ETF and do the market.
Yes.
A couple of other tools people will know. I think many people of your listeners will know TradingView, which is great for graphs. But I would just stress it's not just for looking at the graphs of equities. You can find on TradingView graphs about the inflation rate in each country. You can find graphs about the level of interest rates. You can find the graphs about the GDP. You can find graphs of the debt to GDP. You can find a lot of things you wouldn't know in the TradingView charts. So that's great if you want to bring up, and it's also great for putting in complex formulas. For example, if you, something I did the other day was produce the graph of the value, how much, I did it yesterday actually, how many ounces of gold you could buy with £10,000 since 1971. You can produce that on TradingView. Shall I try and show that to you? I think I'm going to have to pass on that.
Oh no, you're going to have to send it to me. We'll have to overlay it or something.
Let me just have.
I think I can probably tell the listeners while you're having a quick look that my suggestion would be that if you had a look at that view, that chart, it would show you that the ounces of gold that you needed back then versus now would tell me that a lot of people out there are looking at gold in a much shorter time frame and saying, oh, the price of gold has gone from 1900 to 1895. And I'm saying, no, look in a much longer time frame, and you'll see that over time it is doing its job, which is to preserve your purchasing power.
Anyway, I haven't got the chart in front of me, but I can tell you that I remember the numbers. In 1971, £10,000, I'm sorry to talk in pounds because that's the way I was doing it, would buy you 650 ounces of gold.
In 1971?
By 2000, it would buy you 65 ounces of gold. Wow. And today, it will only buy you 6.5 ounces of gold.
Ladies and gentlemen,
so that's how the value of money has gone down.
If you took nothing else out of this interview, I'm going to repeat those numbers. In 1971, £10,000 could have bought you 650 ounces of gold. In 2000, 65 ounces of gold. And today, 6.5 ounces. So for all of you that are out there going, well, I'm not quite sure, I say no more. Clive, that in itself tells us the debasement of the fiat currencies over time.
Yeah, and also you need to be aware what will happen if we start to see our currency depreciating more rapidly. I'm just going to show you here, which I do have, the price of gold in Argentinian pesos. So Argentina is a country with a relatively high inflation rate, and there's never a year goes by when the price of gold in Argentinian pesos isn't higher than it was the year before. It just goes, so we can see the graph going back to 2003 here. It just goes up and up and up, literally forever, because inflation is high. So if we move into a world where distrust of the currency increases and people start to try and get out of it, and it's debasing itself like the Brazilian real, the Argentinian peso, or many other countries, those are being debased against the dollar. But if we get to general debasement against everything, you won't go wrong if you're in a tangible asset, because the tangible assets will buy more and more year after year as the currency debases. And the currency is debasing because they're printing it.
The currencies are debasing. We are running out of time. I would love you to just, if you'd like, leave us with a couple of ideas, if you like. Let's do three pieces of advice that you would give to our beautiful audience out there as we come into 2023.
Firstly, for those who have cash or bonds, they have all the eggs in one basket. Bad thing, because that can go horribly wrong, even though it might seem like a safe investment. That's your first thing. The second thing is, if you're not familiar with investing, try to find ways to deploy your cash into sensible things. It could be property, could be collectibles, or it could be gold, could be equities. And the third thing, if you want to get up to speed with equities, you can buy yourself a nice book like Beginner's Guide to the Investments and find out how to select solid blue chip companies with annuity-like revenues, which will still be here when you retire.
And you can hand them down to the next generation as well. What was that book? What was the book?
Well, it was an illustration. I'm sure there's plenty of books called Beginner's Guide to Investing.
Right. Okay, yeah. Okay,
you won't go wrong with Warren Buffett if you want.
I think
buying a book by Warren Buffett.
The message here, ladies and gentlemen, is don't be a patsy. Don't sit back and think everything's going to be okay. Please get yourself educated. Listen to this interview, not just once, listen to it a few times, because we don't take everything in. And what Clive is suggesting is that real assets in a time of currency debasement is truly what you need to be seeing. And as you all know, I love my gold and silver, got my little silver headband on today. Clive Thompson, it's been an absolute pleasure chatting to you. I hope we chat again, and maybe when we next chat, things might be a little bit more rosy in the kitchen. But for now, Clive Thompson, thank you so much for joining me on Small Caps today.
Thank you, Kerry. And just in case anyone needs a question, I'm on LinkedIn.